Hey, what's up everybody? My name is Kyle Ashcraft of Maxwell CPA Review, and today we're going to learn about the straight line method of depreciation. We're going to learn about the terms like what is depreciation, what is net book value. We're going to learn how to calculate straight line depreciation, and then we're going to do the journal entries for the straight line method of depreciation. So with that, let's jump in. To start out, I feel like it helps to understand the meaning behind accounting terms. So what does it mean to depreciate something? Well, let's think about the opposite of to depreciate, which is to appreciate. When something appreciates, like a stock you own, it means it increases in value. And then when something depreciates, it decreases in value. So a company's fixed assets decrease in value, depreciate, the older they are and the more they're used. After all, who would want to buy your car from you for the same price that you initially bought it from the dealership? So let's dive into how to calculate the straight line method of depreciation. Think about those two words, straight line, meaning even or equal. Your depreciation expense is the same amount every single year. It never changes. So let's say you bought a cell phone for $250 and you think it's going to last for 5 years. So you divide $250 by 50. Therefore, your depreciation expense every year is going to be $50. It's not going to change. After 5 years, your accumulated depreciation will be $250. Since your cost was $250 and your accumulated depreciation is $250, then your asset is worth $0. So when we're talking about what an asset is worth, we're talking about its net book value. Net book value is simply the cost minus accumulated depreciation. So in this example, when we say the asset is worth nothing, then it's the same thing as saying that its net book value is 0. So let's say that after owning your cell phone for 5 years, you sell it for $100. Remember that since you have fully depreciated it, it is worth 0. You're getting $100 for something that is worth 0. So you would have a gain of $100. Now, if you sold your cell phone after 4 years of owning it instead of 5, then it would have accumulated depreciation of $200. Since the cost was $250 and your accumulated depreciation is $200, then it is worth $50. If you sold it for $25, then you're getting $25 for something that is worth $50. Therefore, it would be a loss of $25. In that prior example, we assumed that your cell phone would be worth 0 at the end of its useful life. In other words, we didn't think that we would be able to sell it for anything. But what if we know from experience that after 5 years, companies are going to offer us $50 for the cell phone? Since it will still be worth $50 in 5 years, then we want to use something called salvage value. Salvage value simply means the money we expect to get for selling our fixed asset. We don't want to depreciate the asset for the full amount that we bought it for, so we depreciate it all the way until it is worth the salvage value. So now we have a cell phone that costs $250 and will be worth $50 in 5 years. Therefore, it has to decrease in value, for $200 over 5 years. It can only depreciate $200 because we can't make it worth less than $50. Your annual depreciation will be $40 a year. Now that we've talked about how to calculate straight line depreciation, let's talk through the journal entries. This is for the first example where there was not any salvage value for the cell phone. First, we acquired the cell phone for $250, so we debit fixed assets for $250 and credit cash for $250. Then we have to record depreciation expense each year. So we debit depreciation expense for $50 and we credit accumulated depreciation for $50. And it's as simple as that.